Gold prices received a boost from safe haven demand and falling real yields in the U.S. as risk-off trading has intensified. With U.S. 10 years real yields now back down below -100 BP, gold spiked to above $2,000 per troy ounce, and is currently trading at $2,500 Oz, highest level since August 2020. Prices are set to remain volatile. While not the JPM base case, a continued push lower in real yields, whether from a more dovish Fed than expected or higher inflation breakevens being priced in on the back of the commodities rally, or a combination of the both, and additional boosted safe haven inflation hedging demand for precious metals on the back of a continued melt-up in other commodities, particularly energy, could likely send gold prices up towards $2,200 Oz. The commodities strategy. Team sees the following price ranges for commodities: Brent oil, $100 185/bbl, European gas 80-250 plus EUR/MWh, copper $9,800 12,000/mt, aluminum $3,300 4,700/mt, nickel $26,500 80,000 zinc $3,400 5,000/mt, palladium $2,400 4,000/Oz, platinum $1,030 1,350/Oz, gold $1,800 2,200/Oz, silver $22.50 29.5 Oz, wheat $1,200 800 US Cebu, corn $800 300 Cebu, soybeans $1,600 2,000 US Cebu. See JP Morgan. Researchers' latest energy forecasts and find out what's next for oil and gas prices during the Russia-Ukraine crisis. The Russia-Ukraine conflict has initiated pockets of forex volatility with US dollar, USD, Russian ruble hitting all-time highs. Moves in the broader FX markets have been tame so far. The Japanese yen is likely to outperform with the USD, while euro area currencies are the most exposed. The current geopolitical situation could serve as a catalyst to trigger mean reversion, in which case JP Morgan research would expect the USD, the Swiss franc and the yen to outperform versus high beta currencies. The Russia-Ukraine conflict warrants increasing short euro's exposure in measured size, as the euro would likely weaken versus other reserve FX given the eurozone's reliance on Russia for energy. The Swiss franc would also outperform, though Swiss National Bank intervention may eventually limit gains. Emerging markets. The main emerging market, EM, disruptions resulting from the Russia-Ukraine crisis are tied to commodity prices, monetary policy and the deleveraging of crowded positions. However, geopolitical risks are unlikely to derail the prevailing macro trading narratives in EM. Russia's credit rating was cut to junk across the three major rating agencies, starting with S&P, which downgraded Russia from BBB to BB+ on February 25 and placed the rating on credit watch with negative implications. This was followed by downgrades to junk by Moody's and Fitch on March 2. For EM corporates, the main concern for Russian corporates would be a technical default due to potential payment restrictions, while Ukraine issuers could face operational disruptions or broader reserve depletion. Russian corporates currently have $99 billion of external bonds outstanding, with another $12 billion from Ukraine issues. JP Morgan fixed income indices are following the standardized index approach in response to market disruptions and subsequent impact on the replicability of the indices. Therefore, Russia will be excluded from all JP Morgan fixed income indices starting March 31. Commodity producers in Australia, Canada, Latin America and South Africa stand to benefit from higher commodity prices and the loss in Russian supply to global markets. JP Morgan research expects Asia and Middle East to provide better stability, while Latin America should benefit from higher commodity prices. Asia should be supported by the higher quality composition and greater proportion of a domestic investor base, which should make Asia less susceptible to a reversal in global EM flows, while Middle East should benefit from stronger oil prices. Commodity-heavy Africa should also fare better. For Latin American corporates, the recent sell-off has created better entry points for certain credits such as those in financials, miners and oil and gas exporters. Issuers from these sectors stand to benefit from either rising rates or higher commodity prices. This communication is provided for information purposes only. Please read J.P. Morgan research reports related to its contents for more information, including important disclosures. J.P. Morgan Chase & Company or its affiliates and/or subsidiaries, collectively, J.P. Morgan, normally make a market and trade as principal in securities, other financial products and other asset classes that may be discussed in this communication. This communication has been prepared based upon information, including market prices, data and other information, from sources believed to be reliable, but J.P. Morgan does not warrant its completeness or accuracy except with respect to any disclosures relative to J.P. Morgan and/or its affiliates and an analyst's involvement with any company, or security, other financial product or other asset class, that may be the subject of this communication. Any opinions and estimates constitute a judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. J.P. Morgan Research does not provide individually tailored investment advice. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs and are not intended as recommendations of particular securities, financial instruments or strategies to particular clients. You must make your own independent decisions regarding any securities, financial instruments or strategies mentioned or related to the information herein. Periodic updates may be provided on companies, issuers or industries based on specific developments or announcements, market conditions or any other publicly available information. However, J.P. Morgan may be restricted from updating information contained in this communication for regulatory or other reasons. Clients should contact analysts and execute transactions through a J.P. Morgan subsidiary or affiliate in their home jurisdiction unless governed